if you've all taken your seats, let's stand up for the national anthem, please.
जन गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंधु गुजरात मराठा द्राविड़ उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्छल जलधि तरंगा तब शुभ नामे जागे तब शुभ आशीष मांगे गाहे तब जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
I'd like to do a special welcome and acknowledge the presence of Mr. F.C. Kohli, the founder of TCS and the IT industry in India. Let's give him a warm round of applause, especially on his completing 91 epic years. I was mentioning to somebody, he's always the first person to respond whenever the invitations go out, whether he can make it or he can't make it. This time he called immediately to say he most probably may not be able to make it, but I'm delighted to have him here in our presence. Mr. Ashish Chauhan will join us in a few seconds, so we'll just await his arrival and we'll start. Okay, on behalf of Bombay First and the collaborating chambers, let me welcome you all. To give you an update between the recent few months and what's happening forward. On the 6th of February, we had organized a fabulous conference which attracted something like 650 people in a hall at the Taj Lands End, which had a capacity of just 250. The theme of the conference was Mumbai Next, which was what are we looking at in terms of development next, and I see my beloved Vice Chairman Ashank Desai here. Let's give him a round of applause. Then on the 12th of March, we had a dialogue at the Press Club on the development plan. Mr. Ashish Chauhan has arrived. Let's give him a round of applause. On the 27th of March, we organized a dialogue with Mrs. Ashwini Bhide from the MMRDA on Metro 3, is it a boon or a bane? Then on the 31st of March, we had the Bombay First and the European Union workshop on Mumbai city planning and governance. On the 23rd of April, this is unfortunately a closed-door session, but I might as well share it with you. It's a roundtable on security and the terrorism by an expert called Gary Lafroule. And on the 25th of May, with the European Union again, on major conferences on urbanization. And to give you a peep into what's happening next year in January, most probably, Bombay First, in collaboration with the Government of India and the Government of Maharashtra, will be organizing a global summit, a BRICS conference on modernization of cities. And with that, let me hand over to Mr. Ashish Chauhan to welcome you all officially.
Good evening. On behalf of BSc and its full team, let me extend a warm welcome to Dr. Tarun Ramadorai, Professor of Financial Economics at Saïd School of Business, University of Oxford, at the International Convention Hall of BSc. I'd also like to welcome Sri Narendra Nair, Chairman, Mumbai First, Sri P.S. Reddy, CEO and MD, CDSL, Sri Roger Pereira, Convener, the Collaborating Chamber and Vice Chairman, Mumbai First. I would also like to welcome the dignitaries present in this historic hall. Let me speak a few words on Professor Ramadorai. He is a professor of economics at Saïd School of Business, University of Oxford. His main areas of research are capital markets, international finance, household finance, and Indian economy. He has published extensively on these topics in leading financial and economic journals. In 2012, he was the visiting scholar at Economic Advisory Council to the Prime Minister of India. He was also the economic advisor to the European Securities and Markets Authority. He has also been a senior academic fellow at the Asian Bureau of Finance and Economic Research and a senior non-resident fellow of the National Council of Applied Economic Research. I would also like to thank Mumbai First, the collaborating chambers, CDSL, BSE Broker Forum, and others for conducting a talk on investor learning in the Indian stock market. Professor Ramadorai, and I have been working for last 5 years together. Of course, I won't say we have been working together. He has been taking data from BSE, and he has been doing research. And this is his second time in last 7 days that he is here talking about Indian markets. We take his advice on many things, and I am delighted that he is here. BSE was set up in 1875, 140 years before, and it's the oldest institution of its size, working without any change or without any stoppage for all these 140 years. It's just to give you a perspective. RBI just celebrated 80 years of its existence. BSE is 140 years old, and it is around 10 years elder to Indian National Congress. So that's how BSE has offered an efficient capital raising platform to companies for fundraising. Today, the listed capital is in excess of $1.7 trillion. It's around 9th largest in the world. And what I call it's a risk capital. By just investing in risk capital, today India has been able to create a wealth, or BSE has been helped India create wealth of $1.7 trillion. Over next 20, 30 years, the wealth that needs to, or that will be created is going to be much larger than what we have seen till now. We believe India's market capitalization as listed on BSE probably will rise to $15 to $20 trillion by 2035. BSE has continually tried to encourage retail participation in Indian stock market. Today, I was talking to some friends from abroad that India has around 27.5 million investors. That is 2.75 crore investors registered with BSE as investors who have traded on BSE at least once in last 5 years. If we were a country, we would be 24th largest country in the world. But we are only 2% of India's population. If we are able to reach even 25% of India's population by 2035, we would be one of the largest countries in the world if we were a country. So effectively, we have come a long way over the last 140 years, but we have a longer way to go in getting people to feel comfortable with the new framework which is coming in the Indian markets, that is separating the public debt office from RBI, is going to create a new set of instruments that will be available with the investors. Many of us have not discussed this. Last week, both me and Professor Ramadorai discussed on this same very hall the concept of government bonds to be made available to you and me as individual investors to invest in. Today, it is extremely difficult. If you are to invest in government bonds directly, it will be very, very tough for you to invest directly. You will have to go through a bank, or a bank then in the process invest in government bonds, or through a mutual fund and all, but directly it is not currently easy to invest. It is doable, but very, very tough. With PDO being separated, there is a possibility that the auctions of primary debt of government will also be done through the exchanges, and secondary market of the government bonds also will be available to you and me, whether it is less than 1 year or more than 1 year. And that is going to be a phenomenal framework, because till now, BSE has offered you what I call risk capital and high risk trading. Risk capital is basically investing in equities, and high risk trading is in derivatives. We have not given you a risk-free framework, and once the government bond comes in, we will complete the product framework by giving you risk-free capital or risk-free ability to invest in risk-free instruments. And that is going to be huge, because today most people think that banks are safe and the markets are very volatile, so they are not safe. Once you are able to give a framework where there is going to be no default, because government by framework is not going to default on you on the date they have themselves issued, then you have a risk-free framework, and that is going to change a lot in terms of mindset, and more people will be interested in investing in financial instruments. Today, India invests less than 10% of its savings India saves around 30% of GDP, out of which 10% or less is saved in financial instruments. 90% is invested in other things like real estate and other things. We need to increase that amount to much larger multiples, and that will happen once the government bonds also start sort of coming into the markets. BSE also has a BSE Institute, under which also we do many programs. Our students are proud recipients of knowledge and get experience and hear some of the best personalities in the world of finance and economics. And I'm delighted I can see a lot of students sitting here. BSE also has changed its framework quite a lot over last couple of years. Today, BSE is the fastest exchange in the world. It gives you a response time in 200 microseconds. 1 second has 1 million microseconds, 10 lakh microseconds. So we give you a response time in 1/5000th of a second. By the time you close and you open your eyes, we would have several 100,000 orders that go into our systems. Just to give you a perspective, our system has a capability to take 500,000 orders in a second at that response time of 200 microseconds. If IRCTC, which is the sort of institution which does railway bookings, if they do 5 lakh orders in a day, it's a great day for them. We can take it in a second with a response time of 200 microseconds. So those are the kind of computer systems BSE employs today, and it's 10 times faster than any exchange in the country today. So in fact, BSE has come a long way, and I hope today's discussions will throw a light on how Indian markets are, or how Indian investors behave, because Professor Ramadorai has some amazing anecdotes and, more importantly, amazing research on this topic, which all of us have been waiting to hear from. Thank you very much for coming today.
May I please call Mr. Narendra Nair, Chairman of Bombay First, to please come on the main table, and Mr. P.S. Reddy, MD and CEO of CDSL. Let's welcome them, please. Tarun, over to you.
Great. So thanks very much for all of you turning up. I'm really looking forward to giving you this talk. I've been doing a lot of work in the area of the Indian stock market using some very, very interesting data sets, and I'm looking forward to sharing the results with you today. So I'm an academic from the University of Oxford. So what I'm going to try to do is to try and open the door a little bit to a relatively arcane world for many of you, which is the world of academia. Okay, so we sort of go off in our ivory towers, and every so often what we do in our ivory towers does actually touch real data about decisions that real people make. And so these exercises are quite useful because they allow us to really open the black box a little bit and try to share with you what it is that we're trying to do, and hopefully you'll find that the results are quite interesting and quite exciting. So traditional finance has sort of been divided into two broad areas. Okay, so one of them is called corporate finance, and studies corporate decision making and studies how corporations, for example, raise capital in securities markets. And the other area of finance, which is called asset pricing, traditionally has been about securities markets, which is once you've actually gone and raised the capital and you've put those securities out there, equities or debt or whatever it is, so there's an entire field of finance that just studies how these things are priced and whether the prices are appropriate and rational and so on and so forth. Now, a lot of this kind of work in both corporate finance and securities markets has tended to ignore the people who are making the decisions. And ultimately, one of the most important constituencies of people who are making the decisions about financial markets are people like you and me, okay, households. And so very recently, there's been a revolution in the area of finance. And so we're now starting to get much more interested and study what's called household finance, which is the study of how households like yourselves and myself are out there in the markets making very complicated financial decisions. So for example, all of you have probably at some point or will at some point make decisions about things like home loans, about trading in the equity market. You're certainly going to make decisions about your retirement savings. For example, if you decide that you want a retirement savings plan, that itself is a decision that economists might be interested in studying. And of course, many of you are engaged in the consumer credit market to the extent that you have a credit card or are thinking about getting into that market. And so all of those things require quite complicated financial decisions to be made. And now economists are getting more and more interested in studying those financial decisions. Now, generally speaking, if you think about what in India we sort of push on the policy side, we keep pushing financial inclusion, which is let's get people bank accounts, let's get them into the formal financial system and so on and so forth. But of course, what household finance does is it studies what happens once you've been included, okay? So once you've actually been included into the financial market, what happens then? So it's all about life after financial inclusion. And many of the people who have been included into the financial market will never have had an experience with any formal financial system at all. So it's increasingly important to think about how they make these decisions. And many of them are going to make mistakes. And it turns out that very sophisticated people also make very silly mistakes. Okay? So the study really does focus on common errors that people make. It's very interested in policy. How should we regulate institutions? How should we set up institutions so that people make sensible decisions? And generally, most of the work tends to have this big data focus. Okay, so you've heard about big data a lot, but I mean, this is really where big data is used because you study very large data sets of household financial decisions, and generally people take a global perspective about these kinds of questions. So the kind of work that I've been involved in particular has been together with Harvard University and by a grant sponsored by the Alfred P. Sloan Foundation. We've been sort of working on trying to look at how households make financial decisions all around the world. And if you're interested in some of our work, I would point you in the direction of household-finance.net, and that sort of give you a global overview of the kind of work that's going on in this area. Now, before I sort of go ahead and tell you about what I've been doing, I should have a few acknowledgments. So the data that I'm going to talk about today was very kindly provided by CDSL. So I'd like to thank Mr. Reddy and to thank Naina Overlekar and Rajesh Jatekar and people at CDSL who've been extremely helpful. Many of my collaborators are at Oxford, Harvard, and Wharton, and so I'll be mentioning some of the papers that I've been working on with them. So I'd like to thank them in advance of this talk. Okay, so let's move directly into what we're talking about today. So we're here in the BSE Convention Hall, okay, and this is where people trade risky assets. Okay, so stocks are risky assets. Now, stocks or equities, as it turns out, are like vitamins. Okay, so most economists will tell you, pretty much every standard theory will tell you that you should have some equities in your portfolio. It's good for you. It's like vitamins. You need them in your system. The problem with equities is that they're very harmful if they're misused in exactly the same way that if you take an overdose of vitamins, you might get very ill. Okay, so take too much vitamin D, very bad things can happen to you. Similarly, if you do some very silly things with equities, they can be really harmful to your wealth. Okay, so what kinds of silly things can you do? So common errors that people make, so for example, one of them is that you just get into the market and you diversify very poorly. Okay, so one of the classic lessons of finance is don't put all your eggs in one basket. Try to spread your bets among multiple different types of instruments. So for example, one of the common errors here is you might be very familiar with certain sectors. So you might work in the IT sector and you might decide that since I know the IT sector, that I want to invest only in the IT sector. And that's a really silly error because, especially because you're investing in the IT sector, the last thing you want to do if you're working in the IT sector is invest in the IT sector as well. In fact, what you probably want to do is to short sell the IT sector so that you kill some of that exposure that you have because your labor income is coming from the IT sector. You can trade excessively, so you can just trade very large quantities. You can keep churning your portfolio. And the one thing that that does with perfect certainty is it makes brokers very wealthy, okay? But it doesn't make you very wealthy necessarily. So you have to be very careful about excessive trading. Another one, of course, is the disposition effect. So this is sort of a slightly complicated term that's given to the fact that people often tend to take their losing investments and just hang on to them until they recover. But what they tend to do is as soon as they have an investment that seems to be winning even slightly, they just sell it out of their portfolios. Now, in a market in which you generally have positive momentum, and India is certainly one of them, what you want to do is hang on to your winners and sell your losers as quickly as possible. But people tend to do the reverse. So this can also be a serious problem. And of course, if you picked underperforming stocks, this is also really a great way to lose a lot of money. So these are lots of common errors in India. Now these errors, I gave a talk last year in the same venue, are widely prevalent in India and elsewhere. Okay, so we'll just take it as an article of faith, and I'll show you a little bit of evidence about this, that people make these errors. Now, one of the things that we know is that these errors are much more prevalent amongst people who have just joined the stock market. So rookie investors are much more prone to these errors than veteran investors, and they tend to perform much worse. Okay? So a little bit of experience actually tends to help you. Your performance tends to improve. So let me show you a little bit of the data, just to give you a flavor of what it is. I mean, most of the rest of the talk is going to be pictures, but here I've just got a few numbers. Just so that you are convinced that I'm an academic and I have some academic credentials, I need to show you a few numbers. I could also have shown you a few equations, but I figure showing you a few numbers is probably one way to demonstrate my credibility here. So the data that I'm looking at here is from 2002 to 2012 and pertains to about 6,000 stocks over the period. So stocks are born and die and so on, but over that decade we're looking at 6,000 stocks. Over the period, the retail investor share of the market, that is direct investment in the stock market, is about 11.43%. So the numbers that we're talking about on average is about $135 billion worth of investments. The number of investor accounts, and this is aggregated by PAN that I'm going to be looking at in this talk, and I'll look at a subset of this, is about 17 million investors. Okay? So this is a pretty big data set, and this is, looking at more or less the entire set of investors in the Indian stock market, and we have absolutely wonderful granular data on the decisions that Indian stock market investors are making. So if you look at some of the sort of statistics about the average investors in our data set, at the median, the 50th percentile, these guys are investing about 67,000 rupees in the stock market. But the range is very large, so the smallest accounts are sort of a little less than 7,000 rupees in the market. And the largest accounts are enormous, but for example, at the 90th percentile, we're looking at about 5.5 lakhs of rupees invested in the market. So it really spans the range. Okay? Now, the first mistake that people tend to make is that the number of stocks they hold is very, very small. So finance theory tells you that what you should be holding to get the benefits of diversification is about 30 stocks, roughly. And even at the 90th percentile, investors are only holding about 14 stocks. The median investor is holding 3.5 stocks in their portfolio. So the volatility that they're subject to is pretty enormous. Okay? Now, if you look at how they perform, at the median investor is losing about 1.5% per annum relative to the investment they would have made had they just invested in an index portfolio like the BSE index or an index tracker mutual fund. But again, there's a big variation here. At the 10th percentile, there's some individual who's losing 21% per annum relative to an index investment. So there's some pretty serious errors going on here. Whereas at the 90th percentile, people are making about 18% per annum over that which they would have had in the market. So this is quite substantial. Just two other things I want to point out. The turnover, at the median, investors are churning about a third of their portfolio, 30% of their portfolio per annum. So that means they basically sell off about a third of their stocks and buy back an equivalent number. But at the 90th percentile, they're doing 200% turnover. What does that mean? They're selling their entire portfolio, buying it back again, and doing that twice per year. Now, can you think about the transactions cost that you're incurring when you do that? You're incurring massive brokerage fees, and it's much more likely that you're underperforming as a result of that because your performance will be net of transactions costs than winning. I'll get back to the disposition effect later if I have time. Okay. So what I want to do just for a little while is to talk to you about what it is that we're particularly interested in looking at. Okay? So it's true that the average investor makes mistakes, but the thing that we're really interested in is whether people learn. Okay? So do they learn to do better over time? So with a little bit of experience, are investors getting better over time in the stock market? So economists are generally getting very interested in this concept of learning. Okay? So learning is a sort of, it's kind of a complicated term when you think about it scientifically. So we tend to think about learning as knowledge acquisition, right? So if you read a lot of books or if you go and get an MBA from Saïd Business School at Oxford, the hope is that after paying all of those exorbitant fees, that you're actually learning something through that knowledge acquisition process, okay? But that's not what I'm trying to talk about here. What I'm going to talk about here is learning through experience. So as you've been in the market and as you've been trading in the market, one of the things that happens is you acquire skills. You're learning by doing. Now, of course, there's a little bit of a problem here because learning by doing doesn't necessarily mean that you learn how to do the right thing. Okay? So for example, if you go out there and you like drinking alcohol and you drink a little bit of alcohol and you have a nice time and you enjoy it, you might learn that drinking alcohol is very good for you because it makes you feel good. Now, of course, you know where this is going. If you learn that a little too much, okay, eventually you end up being an alcoholic, and that's not good for anybody. Okay, so that's the sort of a bad kind of reinforcement learning. So learning can be a double-edged sword. So for example, one of the very interesting findings from work in the US is that if you've lived through an experience like the Great Depression, where stock returns were very, very poor historically, people have found in the US that depression babies, those who lived through that period of time, are very reluctant through their lifetimes to hold stocks because they feel like it's just a very bad thing to be invested in the stock market. Now, of course, we've just been through a period of enormous volatility in financial markets, and it's very possible that people have learned that they shouldn't be participating in formal financial markets because of the bad experience that people have had. So what I'm going to talk about today is what about personal experiences? Okay, so these are sort of big aggregate macroeconomic experiences, but maybe you also have some personal experiences when you're trading in the stock market. So for example, you might invest in the stock market, and then suddenly you might get that by luck, one of the stocks in your portfolio just did really, really well. Okay, that's an extreme positive return exposure. Or maybe one did very badly. And maybe those things could teach you that investing is either good or bad, and maybe promote certain kinds of habits that you might have and keep with you throughout your career in the stock market. So for example, another one that you might all be thinking about is what happens if you're exposed to a stock scam. Okay, so just recently we've seen that Ramaling Raju was convicted, right? I mean, he's going to be spending the rest of his life in jail. Right? Now, of course, there's a question here about whether when people held Satyam and there was a massive corporate governance scandal, does that scare them off the stock market for the rest of their lives? What effects does that particular experience have? And now you see how this might become a policy question as well. I mean, are there things that we can do so that people have certain kinds of experiences so that that actually teaches them about the right way to think about investing? So before we get into all of that, we need to figure out whether these experiences actually have any effects at all. And maybe exposure is more important depending on who you are. Maybe if you're a first-time investor and you have a very bad experience, it might affect you much worse than being an investor that's been around for a while, and so on and so forth. Okay, so this is a very critical issue. So Ashish talked about the fact that, that we have a 30% savings rate, right? And only about 10% of that is in formal financial markets. So there's a big, big push now to push people into formal financial markets. But maybe what we want to do is to figure out what kinds of experiences people are having with formal financial markets, because if they're not having very good experiences, they could be making all kinds of really silly mistakes. Okay. Now, here's a little bit of a problem. As an economist, you look at this stuff and you say it's very, very hard to identify the effects of experience. Why? Because experience doesn't just fall from the sky, right? You put yourself in the way of various experiences. So it's very difficult to identify what's cause and what's effect here. So let's think about this a little bit more. So I'm going to talk a little bit about the identification revolution in economics, and then tell you a little bit about a very interesting experience and an experiment that we use to try to identify these effects. Okay, so you've probably heard this if you're a student of economics, and even if you haven't been a student of economics, you've probably heard the statement that correlation and causality are not the same thing. Okay, so let's try and understand what this means in this particular perspective. So I found in this paper with my co-authors, John Campbell and Ben Ranish, that people's behavior tends to be different after their own portfolios have either higher returns or lower returns. Now, the problem with that is that we don't know why the experience happened in the first place. It might be that you put yourself in the way of that experience because you suddenly felt like you wanted to take on more risk. And if you wanted to take on more risk, you got the experience. We then see a behavior changing, but it's all coming from the same source, which is that I have selected myself into that experience. So we can't really identify whether the experience has caused the behavior, or the behavior has changed, causing you to have a particular kind of experience. So this causation and what's a consequence and what's a cause question becomes very difficult to actually answer in any great detail. So what would you like to do? So in economics, what we're thinking about increasingly now, and you may have encountered this when you've heard about things like randomized control trials, about microfinance, or maybe you've heard about this when the economists Abhijit Banerjee and Esther Duflo do all this work on sort of randomized control trials. So what is this? So in medical sciences, when they want to figure out what the effect of a particular drug is, what they do is they pick a treatment population and they pick a control population and they randomly assign them. And then they give the drug to the treatment population and they don't give the drug, or they give a placebo to the control population. And then they see what the effect is on the treatment population. But all of this depends on randomly assigning experiences, in this case the drug, to the treatment population relative to the control population. And so if we can do that in economics, we can really get some great answers. But it's very difficult to find randomly assigned things in economics. Okay? So ideally what we'd like to do is to randomly assign you guys a positive return experience, and the rest of you no return experience at all, or randomly assign you a negative return experience, and then see how you behave relative to this group here. But the question is, where is such an experiment to be found? Okay? And it turns out that in India, we have this wonderful setting where we can actually find these very interesting experiences. Okay? It turns out that in Indian IPOs, and many of you may have participated in IPOs, when retail demand is much, much greater than the supply of shares allocated to retail investors, that is, there's massive oversubscription of IPOs. And in India, of course, most IPOs are oversubscribed when they happen, as it turns out. Then what happens is that there's a particular scenario under which the shares are assigned by a lottery. Okay? And we love lotteries in economics, because what that means is that randomly, you guys, one of you will get a winning ticket and some of you won't. And what I can do is I can look at all the people who applied, and then there's random variation that's caused by the flip of a coin saying you got the IPO and you didn't get the IPO. Now, why are IPOs interesting? They're interesting because, at least on the first day, there are often huge fluctuations in their returns, and we'll see this. In some cases, those returns vary from plus 150% in a day to minus 90% in a day. That's the ranges that we're seeing here. So these are really interesting experiments, and if we can find out who got assigned the IPO and who applied for the IPO and didn't get it, we can compare the behavior of the treatment group to the control group, and that's exactly what we do in this experiment. By the way, there are other countries which have lotteries as well. So what we do is we match investor IPO applications and lottery outcomes to subsequent detailed behavior of investors. We have about 1.5 million investors who are affected by these lotteries in our sample. So this is not a small set of people. This is like 10% of the total retail investor base in the country has at some point been affected by this kind of lottery. We can look at rookie investors versus more experienced investors and see what the effects look like. We can look at investors that have a lot of invested wealth in the market versus very little invested wealth, and then compare the effects for them. We have about 54 IPOs in our sample, okay, and it's a significant stake. It's about 20% of the portfolio. So let me show you what the sample looks like. So this is the total set of IPOs that happened in India. So on the y-axis, there's the number of IPOs. And on the x-axis is the date. So from January 2007 until the end of 2012, okay, what you can see is that these bars represent the number of IPOs. The red bars, the total size of the bar, is the number of IPOs that happened in India. Of these, we're able to identify in our sample the 54 IPOs that are highlighted in blue. So it's a pretty representative experience in terms of tracking roughly what the pattern of total IPOs in the market looks like. Okay. The return experiences themselves vary very dramatically. So for example, in 2007, this plot shows you that the average IPO had a return of 50% on the first day after issuance. And if you look at the red dots, it shows you that the range of those experiences on that first day are from 175% on one day for one stock that you randomly got assigned, up to about 0. And then you can see, looking at the red dots, that you can actually look at experiences that are negative 60% on one day in 2011. So you randomly got assigned a security, you bought it, and then it lost 60% in a day, okay? So I want to see how that random experience of losing 60% in a day has affected you, the treatment group, versus you, the control group, who applied, but luckily didn't get that negative 60% experience. Okay? So that's really the experiment that we're looking at. And we're going to try and see how it affects all kinds of different things about people's behavior. Okay, so we compare the treatment group, those who applied and received the lottery allocation, to the control group, those who applied but didn't receive the lottery allocation. And we need to ensure that you guys, the treatment group and the control group, are not very different in all kinds of different ways. How big your portfolios are, how much you decide to trade, and so on and so forth. So we do what are called balance tests. And all of these things seem to work out really nicely. With a population of 1.5 million investors, it's very easy to get balance because you have huge samples and everything works out very nicely. And then we track a lot of behaviors following the event. So I'm going to show you, everything I'm going to show you from now on is just a picture. So I'm going to show you treatment minus control over the 6 months prior and following. So I'm going to show the difference between the treatment effect and those in the control group. And then I'm going to show you what happens to various different aspects of people's portfolios. Okay. So here we go. So here's the first plot that I wanted to show you. So this is just about what happens. So you'll see in all of these plots that up until the 0 line, the vertical dark line that's sort of highlighted over there, it goes from -6 to 0. So this is 6 months prior to the initial public offering treatment experiment. And then the 0 date is the date of the IPO, okay? And so you figure out whether you got allocated in the treatment group or you didn't in the control group. And then I'm going to track you from 0 to 6 months after the event, just to see what happens to your subsequent behavior. And so the blue line shows you that there's no difference between treatment and control. It's hovering around 0 until the date of the IPO experiment. And on average, across all IPO, 54 IPO experiments, the people who got treated are much more likely to invest in future IPOs if they got a positive return on the day of the IPO experiment, relative to the control group that applied but didn't get allocated. So this is quite interesting because the only difference between the two groups is that you actually had the security because you got allotted it in the lottery. Okay? Now, look at what happens with the red line. These are all of the IPOs that had negative returns, okay, on the first day. And you see that exactly the opposite behavior is happening. The people who got treated and got a negative return on the IPO on the first day are far less likely than the control group to be applying for a future IPO. Okay? So it's basically, it seems the experience of that first day very high positive return is making you more inclined to want to go and invest in an IPO in the future. And if, on the other hand, you experienced a very negative return, you're much less likely to want to go and invest in a future IPO relative to people who didn't get allotted the experience. Now, this is also true for the extent of future IPO participation when you separate it out into accounts that are very small and accounts that are very large. So what I'm doing now is looking to see whether in the set of treatment accounts, whether people who had very large portfolios to begin with are affected about as much as people who had very small portfolios to begin with. And the answer is, the smaller your portfolio, the more important the experience seems to be for you. So if you're an investor that just invested 5,000 rupees in the market, the experience is much more important for you than someone who had 55,000 rupees in the market initially. So small investors are much more affected by large experiences. And this is quite important because financial inclusion is all about targeting small investors to enter the market. What about the difference between people who have just joined the market and people who've been in the market for a long time? It turns out that the effects are much stronger on rookie investors than on veteran investors. And again, you can see that small accounts, new accounts, are much more likely to be influenced by the experience in terms of future IPO participation. Okay, so all of this is interesting. It says that there are significant effects on your future investment propensity in IPOs. You give a thumbs up to future IPOs if your experience is positive, and a thumbs down if you have a negative return experience. We know that the effect is causal because this is coming off a lottery experiment. It sort of works out really well, so you understand exactly what's going on here. The effects seem to be stronger for smaller accounts and rookie accounts, and smaller for bigger accounts and veteran accounts in the stock market. Now, this is what we would call classic reinforcement learning. If you're burned by something, if you're once bitten, you're twice shy. Okay? You don't want to go back into the market if you've had a negative return experience. You definitely want to go back into the market if you've had a positive return experience. Okay? But this is all about just the IPO market. And we might be able to do better because we've got all this other interesting information. So what we're now going to look at is what about behaviors that don't involve IPOs? What about, do you start committing huge volumes of capital to the market, for example, if you've had a positive return experience in an IPO? Answer is, that doesn't seem to change very much, okay? So whoever it is that had a positive experience doesn't seem particularly more likely to come and push huge volumes of capital into the stock market. This is quite interesting because SEBI, for example, has been thinking about guaranteeing returns for small investors in IPOs. But the fact is that we see that the positive experience doesn't actually change your aggregate investment in the market. What does it change, though? It turns out that it's going to change the propensity to trade, it's going to change the number of stocks you hold, and it's going to change the types of stocks you hold. Okay? So that's what we're going to look at now, which is look at the rest of the portfolio and try to think about what happens when you win the lottery of the IPO. And sometimes you lose, right? Because you get a negative return experience. Okay, so let's look at the rest of the portfolio. So the first thing that we find is that, again, this is for above and below median size. So in other words, this is for small investors in green and big investors in blue. So you can see that there aren't too many effects for the big investors, but very strong effects for the smaller investors in the total number of transactions that you do in the market. So if you win an IPO lottery, and if you get those positive returns on the first day, it makes you much more likely to just start churning your portfolio like crazy, because it might be the case that you've interpreted luck in the lottery as being indicative somehow that you are a lucky person or a skillful person or something like that that makes you trade a lot. Now, this isn't a good behavior. You shouldn't be trading a lot, because all you're doing is giving money to the broker. Okay? That's just not a very smart thing to do. But it does seem like it's the case. Now, if I look at rookies versus non-rookies, the effects are much stronger for rookie investors than they are for non-rookie investors. Again, they start churning their portfolios like crazy when they win the lottery relative to the control group. Okay. Sorry, so this was small, large accounts, rookie, veteran investors. That's right. Okay, so this is, again, positive return and negative return. Okay, so now, it also turns out that the number of securities you hold actually go up very dramatically. So even though you're not investing more in the stock market, the good news is you're spreading your bets among a larger number of stocks once you've had this positive return experience and you've won the IPO lottery. Okay? Now, of course, the question is, what stocks are you investing in? And should you be investing in those stocks? What happens to your portfolio after you've won this lottery? So what we do is we go straight to this point of familiarity with the IPO sector. So let me try and explain what this plot is doing here. So what we're trying to do here is to say there are lots of different types of IPOs that happen in India. There's manufacturing sector IPOs, there's tech sector IPOs, there's IPOs in e-commerce stocks, there's IPOs in old economy tech stocks, and so on and so forth. Now, one hypothesis that we had is that if, for example, you win in a tech stock IPO, in other words, you randomly get allocated tech sector stocks in the IPO lottery relative to people who applied and didn't get allotted, maybe you start to believe that the tech sector is your friend, and you start to go into more of tech stocks in your portfolio. And that's exactly what we find. We find that when people win in an IPO lottery in tech stocks, they tend to concentrate their portfolio in tech stocks. When they win an IPO lottery in manufacturing stocks, they tend to concentrate their portfolio in manufacturing stocks, and so on and so forth. So people really do feel like this experiment or this experience of winning really does sort of seem to make them feel like, you know, certain types of stocks are much better than other types of stocks. And that's really unusual behavior from the perspective of economists, but it does seem to work. Okay? Again, the effects are much stronger for smaller accounts than for larger accounts. They're much, much stronger for new rookie accounts in the stock market relative to veteran accounts. And again, if you had a positive return experience, it makes you want to invest in the sector with which you're familiar. In other words, the sector in which you've won the IPO lottery. But if you've had a bad return experience, you actually shun that sector. Okay? So in other words, if you randomly got allocated stocks in a tech sector IPO and it made minus 60% returns on the first day, you're very likely never to go into a tech sector IPO again, even though finance theory would tell you that that one experience shouldn't make any difference to the decisions that you're actually making. Okay, so we've seen a lot of results. So what are we to make about all of this? So let me just sort of wrap up, tell you a few things about what we think is going on, and then I'm really looking forward to hearing your questions about the work that we've done. So what we find is that positive IPO experiences make investors much more likely to apply for future IPOs. It makes them increase the trading activity in their portfolios. It makes them increase the number of stocks that they hold in their portfolios, even though they don't want to commit any new money to the stock market. So they spread whatever existing money they've allocated to the market across a greater number of stocks. And they do tend, when they've had positive return experiences, to tilt their portfolios towards the sector of the IPO in which they got treated. Okay? The effects generally across the board seem to be stronger for rookies and for smaller accounts. So in other words, if you're a veteran, you're less susceptible to these sorts of effects. If you have a bigger account, you're less susceptible to these sorts of effects. And these effects seem to be in the same direction as the first day IPO returns. So if you had a positive return experience, you do all of this sort of stuff. If you had a negative return experience, you start moving away and doing much less of these sorts of behaviors. So what are the implications of all of this work? So I think we've identified here pretty convincingly, at least to my liking, that experience does seem to matter. Okay? Paradoxically, the thing that sort of is a little troubling about this is that if you have good performance early on, like if you win an IPO which has 100% returns on the first day, it seems to encourage very bad behavior in the future. So in fact, one of the best things that might happen to you is that you have a very bad experience early on in the stock market because that forces you to be a little bit more sensible in the future. Okay, so this is a very paradoxical result that like earning a lot of money in the stock market in the first 6 months of trading just doesn't seem to be a very sensible thing. Okay, it's like not a good thing for you. Okay? Now, what are the policy implications here for increasing retail investor participation in either the initial public offering market or even in formal financial markets? So clearly guaranteeing returns, I mean, we seem to think that this research is saying to us that this is going to generate some perverse outcomes because it's not an accurate representation of reality. Okay? I mean, we know that people are heavily experienced and heavily influenced by the experiences that they have. So if you create these synthetic experiences for them, which are absolutely not what they're going to get in the stock market, so if you guarantee to them that you're going to get 5% or 10% returns when you invest, you're going to set up expectations which are very unrealistic, and you might actually generate very perverse outcomes in the future. Now, we know that veterans are less susceptible to these kinds of errors. So, maybe here's a little out-of-the-box policy implication. When we learn how to drive, we don't just give people a car and say, go out there, okay? Go as fast as you can. Here's a Lamborghini Huracan, okay? Drive it as fast as you want on the C-Link if Arnab Goswami isn't around, okay? That doesn't actually happen, right? What happens is you have to learn how to drive. You have to get a learner's permit. You have to go through an entire certification regime. And once you've been certified, you actually get to go out there and do whatever you want, right? I mean, it's just about a part of growing up and responsible behavior and so on. So maybe, for example, you could create a little bit of a learner's permit where you actually force people to work on a simulator and run a paper portfolio before they actually go into the market. This is just a suggestion, right? Now, this is not unusual. In Brazil, if you look at the Bovespa, they have a lot of these simulators where they simulate trading, and there are a lot of people who go into the simulator before they're actually running real portfolios. So maybe that's one approach to this problem. The other question that this sort of generates is, we know that experience affects people. We know, for example, that experience of the Great Depression makes it very difficult for people to invest in the stock market. So the questions that the regulator might want to be thinking about are there lots of people in the market right now who've had particular kinds of experiences? And is that going to generate particular kinds of market outcomes going forward? For example, we've just had a Satyam problem. There may be a lot of investors who've been through that and lived that experience. Does that then change the implications for regulatory policy going forward? Okay? So here's just some thoughts about the work that we've been doing. And thank you for giving me the opportunity to share this with you. And I look forward to your comments.
We'll now open the house to question and answers. Since we have a fair representation of the student community, let's start with the student community first. Raise your hands, mention your name, and the microphone will come to you, and the institution you belong to. I see hands going up. Okay, let's start here.
Yeah. My question for you is twofold. One is that there has been a slight change in policy on the IPO opening day. Now we have something called option, first out, and determines the price band of the price band. So kind of that would change. Really my question is, how do you ensure penetration? Because today
Yeah, it's working, right?
So, yeah, so that's a great question. So the question was, if you want to encourage increasing investor participation in the stock market, and we know that experiences matter and really affect people in a positive or negative way, what's the right way to channel people into formal financial savings or to pull them into the stock market? And then there were some questions about the details of the trading process as well. Now, one of the things I would say is that the IPO market, which by its very nature is about brand new companies that are coming in, massive valuation uncertainty because people don't know how to value the cash flows. This is a new security that's being issued on the market. I don't think that this is the best way to give people their first experience of formal financial markets. Okay? It's like saying you are 5 years old and you've just learned how to walk, and I'm going to put you on a bungee jumping instrument, okay, and say I'm going to throw you off a bridge and you'll have a lot of fun, okay? Now, of course, the question is that really going to do something that is long-term, sustainable, really build you into a trading ecosystem? So in some sense, I think some financial instruments need to come with health warnings, right? To say, if you're old enough and you're responsible enough, we sort of allow you to participate in this stuff. And so maybe one of the conclusions of this is, if you want to encourage formal participation in the financial market, maybe you try to think about ways to do that, which are a gentle introduction to the fact that there is volatility, there is risk. You can't hide that fact, but maybe what you do is you steer people away towards things that get them up to a point where they've learned, they become a veteran, and then after that, experiences, as we know, don't affect veterans that have been around in formal financial market situations for a while. So I think that this is sort of more generally the lesson that we would have here for you.
Yeah. Can we get a microphone here, Rayleigh? First row. Is the microphone on?
There's a few guys in the back.
Sorry?
A few guys in the back.
Yes, on.
Hi, Tarun. I'm Gangadhar from Nomura Securities. My question is a little academic. What the observed numbers that we have seen could have reflected just as much a behavioral experience as that of a finance constraints. i.e., when you have a large negative, return experience, that return experience could have provoked certain liquidity or finance constraints. In which case, you could have still got similar, outcomes. So, in the analysis, how do we distinguish between what's a behavioral bias versus a liquidity constraint? In another simpler way of putting is, suppose you create a bank that funds freely the investors to absorb the losses. Sure. Would the result be different? Thank you.
So that's a great question. So there are two responses to that question. One of them is that even though the effects are muted for people who have very large accounts and therefore are not likely to suffer from liquidity problems, we still find that the effects exist. They're muted, but they do exist. So pretty clearly, even people who don't have a liquidity problem seem to be affected by the experiences that we're seeing. That's kind of the first point. The second one is that the way that the behaviors work, they sort of seem to be, in some sense, it's difficult to square them with a story about liquidity. So let me give you an example. One of the effects that I didn't show you is that the tendency to hang on to losing investments and sell winning investments changes also quite dramatically following the IPO. Okay? So that's sort of one thing that it's difficult to explain using questions of liquidity. The other one is that holding the size of the portfolio constant, we find that people tilt their portfolios towards specific sectors of the IPO universe. So it's very difficult to argue that it's a liquidity problem that caused you to get into manufacturing stocks a bit more, not the one that, by the way, was given to you in the IPO, but other manufacturing stocks, net new purchases, just because you won in the manufacturing stock IPO.
Did we see some hands at the back?
And there's one back there.
Yeah. Yes, please announce your name.
Yep. Good evening, sir. So my name is Siddharth, and I'm from TFI Management Institute, Manipal. So in one of the slides, you had spoken about portfolio variance and the number of stocks held. So I think it said that for one stock, it was about 24%, if I remember right, and for 14 stocks, it was 68%.
So I should have, okay, so let me just clarify before we go on to the rest of your question. Each one of those statistics shows a different distribution. They're not linked. So in other words, at the median guy is holding 3.4 stocks. It's not that guy who has an idiosyncratic portfolio variance of 48%. Separately, the distribution of idiosyncratic variance is such that at the median guy has 48% idiosyncratic variance. That could or could not be the guy at 3.4 stocks. Totally different set of stocks.
So which basically doesn't mean that if a person holds 14 stocks, the diversification is not proper. It might be that it's just 14 stocks.
Absolutely. That's right. Does that answer your question? Thought it did. Okay, good.
Okay. Good evening. My name is Sunil. I'm from WFSL. My question is, once you lost money in excessive trading, should we look at that again? And if yes, then how?
What do you mean, look at it again?
If in particular script we have done excessive trading, we lost money in that. So should we look at that again, or
I see.
How should we make up our mind?
So economists will tell you, so one of the statements one of the irritating statements that economists keep making, and I will make it again here, I'm sorry to be irritated, is that sunk costs don't matter.
Okay.
Okay? This is another convenient way of saying this, and you know, you've probably heard this from your friends or your parents. Don't think about the past.
Okay.
Okay? So another way to say this is you should be evaluating all of your investments on a going forward basis,
okay,
rather than thinking about stuff that's already happened.
Okay.
So for example, I'll give you an example of this. Institutions have specific rules in trading very often.
Yeah.
They have what's known as stop losses.
Okay.
If a stock falls 5%, you kill it. If it falls, why is that?
Yeah.
It's because what they want you to do is to evaluate that as a new investment.
Okay.
In other words, if you bought it at 100 and it went down to 95,
yeah,
you sell the investment, and then you re-optimize completely and you say, look, do I really want to think about this stock when I don't own it? Because owning something can sometimes distort the way you think about it.
Okay.
Okay?
Thank you.
Back there.
Hi, it's Alok Shirsagar from McKinsey. Terrific talk, Tarun. Two questions for you. One is, have you studied the impact of this on professionals, as in portfolio managers, and how they operate under the same behavioral biases? And the second is, when you think about the movement towards more packaged products, whether ETFs, mutual funds, or the ULIP experience in India, to what extent will the same issues also occur when you buy packaged products that also have volatility, particularly when you think about public sector ETFs or other things that are planned?
Okay, great questions. So the answer to the first question is that are professionals susceptible to the same sorts of biases that we've seen here? The answer is yes, they are. And we've seen that. So there's plenty of research, including some that I've done myself, in other settings, not in the Indian setting, but in the US setting and in other places like that, that shows that actually institutions are also susceptible to these kinds of errors. The difference is that they seem to have mechanisms in place that limit the extent to which those errors affect them. So for example, stop losses, investment committees where one person doesn't make the decision, but it's a consensus decision, situations where you have to discuss and defend your investment decisions with people who are compensated to be hostile to the kinds of ideas that you might have. So all of these things actually limit the extent to which institutions demonstrate these behavioral biases. And in fact, it gets worse. Because of the fact that individuals demonstrate these biases a lot, and institutions don't do that as much, every time there's a salient event, like an earnings announcement that's a big surprise, there's a net wealth transfer from individuals to institutions at times like this. So one lesson that we have sort of learned from decades of kind of work in academia is you shouldn't be doing it on your own. Okay? If you think that you're a really good day trader, then you probably aren't. Okay? So it's actually a pretty good idea to leave it to the professionals. All right? It's a smart move to actually delegate. Now that then brings you to the next question, which is, suppose we do create these mechanisms for you to get diversification by creating an ETF, or we create a mutual fund, or we create a life cycle portfolio that's what's called a target date portfolio that gives you retirement savings at exactly the right time. Does that solve all of your problems? The answer is it doesn't solve all of your problems, because obviously one of the things we can't do is to take discretion away from the investor who delegates money to that instrument in the first place. So another way to say this is, there is simply no way to insulate investors from the consequences of their own stupidity. Okay? So unfortunately, there's very little to do that we can do here. One of the things that I'm suggesting is that maybe what you do is you apply this learner's permit system, where you certify people for suitability for certain products. And increasingly, the Financial Conduct Authority in the United Kingdom and the Consumer Financial Protection Bureau in the United States are actually doing this. They're gauging suitability of particular investors for particular products. And I think we're going to see more of that going forward.
Shall we take one more? Yes, Farooq. Can we get a microphone here?
Farooq Subeda, Tata Sons. You made a passing reference to a 30-stock portfolio.
Right.
Would that number go up as the size of the portfolio? Or in some of our investment companies, we have an endless debate on an optimum size to a portfolio, not more than 20. Some people say 10. What would be your view on that?
Okay. So the passing reference I made was to studies that have done things where they simply pick 30 random stocks. And then what they do is they look at the decay in portfolio variance as you keep picking random stocks and adding them to the portfolio. So in the US, for example, now of course it differs depending on volatility environments. So in India, where idiosyncratic volatility is higher, this may be different. As you hit 30, you sort of get to the asymptote. Okay? So getting to 100 in terms of idiosyncratic volatility doesn't seem like it's going to change your life very much relative to having 30 stocks in your portfolio. This should not be interpreted as a recommendation that 30 is the optimal number of stocks to have in a portfolio. It depends a lot on which sectors you're concentrated in, and if you are concentrated in certain sectors, on the limits and the capacity within your organization to process information. So for example, the largest mutual funds in the world generally don't have more than 100 stocks at any given point in time, partly because in terms of the fundamental research that they're supposed to be doing about these stocks, very difficult to do that at a scale that has more than 100 stocks in it. So a lot of that stuff is going to depend very much on the economics of the information production within the firm. All I'm pointing out is that if you wanted to just pick a number of random stocks, you will achieve the theoretical benefits of diversification at the point where you've got about 30 in your portfolio. So certainly when I see the median investor in India holding 3.5 stocks, I worry that they're carrying a huge amount of idiosyncratic risk in their portfolios.
The 100 stocks were across schemes or?
Yeah, across
schemes.
Absolutely, yeah.
For the whole fund.
Yeah.
Okay, we'll take one last question.
Okay. Gentleman over there.
You're going to get 2 microphones.
He's got a mic.
Hello. Yeah, I am a domain specialist with TCS and I'm MBA in finance. I think the study kind of simplifies some of the questions or assumptions with a retail investor to make. Okay. Here I want to represent myself as a present-day retail investor, and I think the present-day retail investor has far more intriguing questions to ask. Why would what would be the average down on a IPO of, like you mentioned, minus 60%? The retail investor will start asking questions like, why did it go why is the variance so much? Is there, what kind of depth does the IPO market in India have? For example, if you say a technology stock, solar stock, a solar stock in NASDAQ, vis-a-vis a solar stock in India, so there are so many more intriguing questions. And secondly, the behavior, as mentioned by Mr. Ashish Chauhan, that 10% of the savings. Probably all these are also pre-factored questions which the investors are asking in terms of one is the quality of the stocks. Second is the regulatory mechanisms which are there. Bad debt.
Sorry, is there a question?
No. So these are some of the more deep questions also which the retail investors might be asking.
Okay. So in response to your statements, I mean, far as I understand, what you're saying is that there are lots and lots of things that retail investors talk about. That's absolutely right, and think about. I mean, there's no question that this is a bewildering environment with a huge amount of information that is floating around, and that people sometimes have to make very complicated decisions with very little information, okay? Now, there are two things I will point out. So the first is that when you have an experimental setting where you're able to control large sets of investors, all of whom are facing very similar choices to the ones that you're talking about, but you've got this nice clean source of experimental variation, what that allows you to do is to really cut to the chase and say, it doesn't really matter because we can just average out all of that behavior on the margin and then just compare the control group with the treatment group. And that's really what experiments allow you to do. They allow you to cut through a lot of these issues. Now, a statement on your points about the complexity of retail investors. It's very important to recognize that retail investors think that they are doing very complicated calculations. The more complicated the calculation a retail investor thinks that they are doing, the more likely that they're making serious errors in managing their portfolio. Okay? Because one of the things that happens is that you have the illusion of control in situations like this. And the illusion of control generates overconfidence, and overconfidence generates a very high propensity to trade. And from loads of research in the United States and in Scandinavia and all kinds of other countries where we have very detailed data on people's decision-making processes, one thing we know is that the people who are the most overconfident, now it turns out single men trading on the internet, they are the absolute worst, okay? Married women trading over the phone are absolutely the best in terms of the performance of their portfolios. Why? Because they tend to trade less and they don't waste money on transactions costs, and therefore their returns actually tend to be a lot better. So it can be very dangerous to think that this is a complicated problem that you think is very exciting, because what that does is it can be very hazardous to your wealth. Okay? So.
Yep. Thank you.
Thank you so much, Tarun. Let's give him a warm round of applause. It's a very insightful. And may I request Mr. Nayan Mehta, the CFO of BSE, to kindly hand over a memento to Dr. Tarun Ramadorai as a token of our appreciation.
Thank you. Oh, wow. It's lovely. Okay. Thanks.
And now may I request Mr. Reddy to kindly propose a vote of thanks. And don't run away after that. Please join us for refreshments at the counter over there.
Thank you.
Oh, you would also like to hand over. Okay.
Thank you. I see the gift from the BSE and I really like it. It's wonderful. I just wonder whether it's a statement about what I've been saying.
Mr. Reddy?
SEBI has been asking us, maybe in various meetings, including the investor association meetings, how do we shore up the number of investors in stock market? Intuitively, some investor associations tell that you please go back to the CCI days where price is fixed. And again, intuitively, SEBI tells that it is bad for investors, and that is borne by the research that Mr. Tarun has, Professor Tarun has disclosed, that yes, maybe investors, those who have made good money in IPOs, they tend to participate more actively. And it is the IPO market, revival of IPO market only brings back maybe dozens of investors, not dozens, millions of investors into stock market. And again, that may not be a good way of doing it. So in between, as market infrastructure institutions, we are sandwiched as to how to bring in more investors into the market. And probably one example that he has given is, popularizing simulators for investors to learn as to how to trade in the stock market is one good thing. I'm sure BTA and other some of the institutions have it, but it should be made available to the investing public as if it is it's a kind of set up more and more kiosks, and any investor can walk in and then experience. And it's like a game, they should be allowed to participate and win whatever they want. Probably that will help in popularizing this kind of culture. Thank you, sir, for sparing your valuable time and doing so much research and sharing with us your valuable findings. And I also thank Mumbai First, BSc, and other supporting organizations in holding this event. And I'm grateful to all of you for sparing your valuable time and coming and attending this program. Thank you so much.